Babcock reported its strongest underlying profit in years, and the market sold it off anyway, because the £140 million charge arrived simultaneously, and most readers stopped at that number without asking what kind of charge it actually is. The distinction matters for capital allocation. A charge taken early in construction reflects a design problem that can still be cheaply corrected. A charge taken in the outfitting and commissioning phase, which is where this one sits, means the ship is already largely built, and the rework requires dismantling finished work to reach the underlying fault. That is not the same financial exposure. Late-stage rework on a naval vessel carries a cost multiplier that early-stage changes do not, because every hour of labor is competing against a delivery schedule that is already under pressure. Babcock confirmed the rework is occurring across ships 1 and 2, which are furthest along in the build sequence at Roseth. Ships 3 and 4, still in earlier construction stages, are materially less exposed to the same rework cascade. The firm fixed-price contract structure is the mechanism that translates this operational reality into a capital event for equity holders. The Ministry of Defense carries no liability for the overrun. The £140 million sits entirely on Babcock's balance sheet, not the taxpayers. That contract structure also means there is no negotiated settlement to wait for, no government offset to model. The exposure is already defined, which is what allowed Babcock to book the full £140 million as a single reestimate rather than a rolling series of charges. The £100 million revenue reversal embedded in that figure is the more structurally significant component. It does not represent cash that left the business. It represents revenue recognized in prior periods that no longer meets the completion threshold and must be unwound. That unwinding compresses the reported margin on the program retroactively, which is why underlying operating profit fell to £293 million from £363 million in the prior year, even as the rest of the business was growing at double digits. But the charge being a single full reestimate rather than a partial provision changes the risk profile going forward, and that distinction is what the initial market reaction almost certainly failed to price correctly. The 19% underlying profit growth to £433 million is not a counterweight to the Type 31 charge. It is evidence that the two businesses within Babcock are operating on entirely separate trajectories, which is the factor that repositions how the damage is priced. Nuclear revenue grew 14% and aviation grew 34%, both of which are long-cycle, government-contracted revenue streams with visibility that the marine program does not currently have. That growth rate in nuclear and aviation did not decelerate because of the Type 31 charge. It accelerated into the same reporting period. Free cash flow of £262 million before the Type 31 impact confirms the underlying business is converting profit at a high rate, which means the £140 million charge is a margin event on one program, not a cash flow deterioration across the group. The 8.2% underlying margin, up 70 basis points year-on-year, is the number that reframes the charge. A business with a deteriorating core would not expand margin while absorbing a late-stage shipbuilding overrun in the same period. As a counter-signal, the marine segment itself grew revenue 8%, meaning the Type 31 exposure has not contaminated the broader marine order book's performance signal. The damage is program-specific, not division-wide. The 70% of fiscal 2027 revenue already under contract at this point in the year is the visibility metric that shifts how forward earnings should be discounted. Most of next year's revenue is not contingent on new wins, it is already contracted, which limits the duration over which the Type 31 cloud can rationally suppress the valuation. What the 70% contracted coverage does not answer is whether the £140 million is actually sufficient, and that is the question the incoming chief executive inherits on day one.
Babcock's share price had already fallen by roughly a third from its all-time high before this charge was announced, which means the equity market had been pricing in execution risk on the Type 31 program for months before management confirmed it in numbers. That prior derating matters because it changes what the £140 million charge signals to remaining holders. A charge arriving after a 33% drawdown is not the same capital event as a charge arriving into a stock at peak valuation. The question is whether the drawdown already absorbed the damage or whether the charge reveals a larger structural problem the market had not yet scoped. The incoming CEO, David Lockwood's successor scheduled to take the role in June, inherits precisely this ambiguity. The £140 million was booked as a full re-estimate, implying management believes the scope is now fully defined, but that assertion has not been independently validated on a program where ships 3 and 4 are still in early construction. Ships 3 and 4 being less advanced is the structural argument for containment. The rework cascade that drove costs on ships 1 and 2 was triggered by late-stage design changes, and earlier-stage ships can theoretically incorporate those changes at lower unit cost. If that logic holds, the charge is genuinely a one-time re-estimate rather than the first installment of a multi-year bleed. The condition that would confirm containment is ships 3 and 4 completing their outfitting phases without a further provision. The condition that would disconfirm it is a second charge announcement within the next 12 to 18 months, which is precisely the test the new CEO's credibility will be measured against from June onward. The £200 million share buyback announced for fiscal 2027 is management's own signal that they consider the balance sheet robust enough to return capital while the program runs off. A company uncertain about further charges does not announce a buyback of that scale simultaneously with a £140 million write-down. The two signals in combination are the strongest available evidence that the board believes the re-estimate is complete. But the buyback also creates a new verification benchmark. If further charges emerge before the buyback completes, the capital return commitment will have functioned as a credibility anchor that management then had to walk back, and that scenario would reprice execution risk across Babcock's entire contract book, not just the Type 31 program. The £140 million figure introduced at the start of this analysis is therefore not a closed chapter. It is the threshold against which the incoming CEO's first 12 months will be judged, and the buyback is the commitment that makes the sufficiency question impossible to defer. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.